Hello, financial enthusiasts. Welcome to another informative session with Caffeinated Money. We're your go-to hub for all things finance, where we break down complex concepts into easily digestible insights. Today, we've brewed up something exceptionally interesting for you. We're going to delve into the world of dividend investing, a strategy that holds great potential for consistent income generation. But how do you go about it? How do you pick the right stocks that pay dividends? Well, that's precisely what we're about to uncover. We'll guide you through the process, unravel the key considerations, and help you make informed decisions. So sit back, grab your cup of coffee, and let's get started on this journey to financial acumen. Before diving into the topic, make sure to hit the subscribe button and turn on the notifications so you never miss any of our educational content. First things first, what is dividend investing? Now, this is a question that's crucial to understanding the stock market. Dividend investing is a strategy that focuses on buying shares in companies that regularly pay dividends. Dividends are portions of a company's earnings that are distributed to shareholders, usually on a quarterly basis. But why is dividend investing beneficial? Well, one of the most attractive aspects of dividend investing is the potential for a steady stream of income. When you invest in a dividend-paying stock, you're essentially becoming a part owner of that company. As the company profits, so do you, receiving your share of the earnings in the form of dividends. So imagine you've got a collection of these dividend-paying stocks in your portfolio. Over time, these dividends can add up, potentially providing you with a consistent income. And the best part? This income is generally passive, meaning you're earning money without having to actively work for it. Now let's talk about the basics of dividend yield and dividend growth. The dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. In simple terms, it gives you an idea of the return you'll get from the dividend alone. On the other hand, dividend growth refers to the annual rate at which the dividend payout is increasing. Companies with a history of consistent dividend growth are often seen as reliable and financially stable, making them attractive for long-term investment. But here's the catch. High dividend yield doesn't always mean a good investment. It's crucial to consider other factors, such as the company's financial health, market position, and growth prospects. So, dividend investing is a great way to generate passive income. But how do you pick the right stocks? Well, that's a whole other topic, and we're going to dive right into it in the next scene. So keep watching to unlock the secrets of successful dividend investing. Choosing the right dividend stocks is crucial for your financial success. Now that we've unraveled the concept of dividend investing, let's dive into how to pick the right dividend stocks. When selecting dividend stocks, you should first examine the company's financial health. This involves checking out the balance sheet and income statement. A company in good financial health typically has low debt, strong cash flow, and steady earnings. These factors suggest that the company can continue paying dividends consistently, which is what you're looking for as an investor. Next, consider the payout ratio, a key metric in dividend investing. The payout ratio is the percentage of earnings a company pays out to shareholders in the form of dividends. A lower payout ratio suggests that a company is retaining more of its earnings for growth, which could lead to higher dividends in the future. However, a high payout ratio isn't necessarily a red flag. It could mean that the company is mature and has less need for reinvestment. The key is to strike a balance. Another crucial factor is the company's dividend history. Consistent dividend payments over a long period indicate a company's commitment to returning capital to shareholders. If a company has a history of cutting dividends, that might be a sign to steer clear. Now, let's talk about diversification. Spreading your investments across different sectors helps to mitigate risk. If one sector underperforms, your other investments can help cushion the blow. It's all about not putting all your eggs in one basket. Finally, look beyond the dividend. A high dividend yield can be enticing, but it's not the be-all and end-all. You should also consider the company's potential for growth and stability. After all, investing is a long-term game. Remember, the goal is not just to pick stocks with high dividends, but also those with potential for growth and stability. So keep these factors in mind as you build your dividend portfolio. Happy investing! Now that we understand the basics, let's go through some examples. Imagine you're on a quest, hunting for the golden goose of dividend stocks. You're armed with the knowledge of what makes a good dividend stock: solid fundamentals, consistent dividend growth, and a reasonable payout ratio. Let's dive into a few examples of stocks that fit these criteria. First off, let's talk about a company that's been a staple in the world of dividend investing: Procter & Gamble. If you've ever brushed your teeth, washed your hair, or done your laundry, chances are you've used a Procter & Gamble product. They own a massive portfolio of household brands, and they've been paying dividends for over a century. They've also increased their dividend every year for the past 6 decades. That's the kind of consistency you want in a dividend stock. Now let's consider a company from the tech sector, Microsoft. Yes, the tech sector isn't typically known for dividends, but Microsoft is an exception. They've been paying dividends since 2003, and they've consistently increased their dividend every year. What makes Microsoft a good pick? Their strong fundamentals, consistent dividend growth, and sustainable payout ratio. Plus, they're a leader in a growth industry, which bodes well for their future prospects. Next, let's look at a company from the healthcare sector, Johnson & Johnson. This company is a perfect example of a dividend aristocrat. They've been paying dividends for over 50 years and have increased their dividend every year for the past 5 decades. They have a diverse product portfolio including consumer goods, pharmaceuticals, and medical devices, which helps them maintain steady cash flow. Finally, let's talk about a company from the financial sector, JP Chase. They've been paying dividends since the late 1800s and have consistently increased their dividend over the past decade. They have a solid balance sheet, and their dividend yield is attractive. Now these are just examples, not recommendations. The point here is to illustrate what good dividend stocks look like, and why they are considered good picks. Notice how each of these companies has a history of paying dividends, strong fundamentals, and a sustainable payout ratio. They're all leaders in their respective industries and have resilient business models that allow them to weather economic downturns. Remember, investing in dividend stocks is not just about the yield. It's about the total return, the combination of capital gains and dividends. And while past performance is not a guarantee of future results, a track record of consistent dividends can be a good indicator of a company's financial health and commitment to returning capital to shareholders. These examples should give you a better idea of what to look for when picking dividend stocks. To recap, we've learned about dividend investing and how to pick the right stocks. We've delved into the world of dividends, understanding how they can provide a steady stream of income and add a layer of stability to your investment portfolio. Unlike some other forms of investing, dividends are not just about speculation. They are about owning a piece of a profitable company that shares its success with its shareholders. We've also explored how to identify the right dividend stocks. It's not as simple as choosing the stocks with the highest yields. Factors like the company's financial health, its dividend history, and its position within its industry are all critical considerations. Remember, a high yield might be enticing, but it's the sustainability of those dividends that truly matters. We've discussed the importance of a company's payout ratio, which tells us what portion of its earnings is being given back to shareholders. A ratio that's too high might signal financial stress, while a ratio that's too low could indicate missed opportunities for investor returns. Finding that balance is key. And let's not forget about diversification. Spreading your investments across different industries and companies can help manage risk. It's like the old saying goes, don't put all your eggs in one basket. Diversification can help ensure that a poor performance by a single stock doesn't significantly impact your overall portfolio. But most importantly, we've emphasized the need for ongoing learning and research. The world of investing is constantly evolving, and staying informed is essential for success. There's no substitute for doing your own homework and making informed decisions based on your personal financial goals. And that's a wrap. Remember to do your research and never stop learning. Don't forget to subscribe for more financial tips and tricks. Until next time, this is Caffeinated Money signing off.